Platinum is one of the world's rarest and most versatile precious metals, straddling both high technology applications and boutique investment demand. Over the next 5 minutes, we'll explore its constrained supply, diversified demand profile, recent price dynamics, and the strategic mindset guiding both institutional and retail investors. Total annual mine production of platinum is only about 200 metric tons, less than 1/100th of global gold output. Cumulative above-ground stock stands near 3,500 metric tons, enough to fill a cube just 9.5 meters on each side. Production is highly concentrated. South Africa supplies roughly 70% of new platinum from the Bushveld complex. Russia's Norilsk and Zimbabwe's Great Dyke account for most of the remainder. Secondary recycling contributes only 0.25 tons annually, 12% of supply. Despite technological advances, primary supply has been flat for 2 decades due to labor strikes, ore grade decline, and limited new discoveries. Mine life average is just 15-20 years, making platinum one of the most geopolitically sensitive metals. Platinum demand splits across industrial and investment channels. Automotive catalysts, 35-40% of demand. Platinum is critical in auto catalysts for gasoline and diesel vehicles to reduce NOx, CO and hydrocarbons. Stricter Euro 7 regulations in Europe and global tightening of emission standards have sustained demand of 70 tons annually. Industrial and chemical applications, 20-25%. Used in nitric acid production, petroleum refining, and in fuel cell electrodes for hydrogen energy. Polymer electrolyte membrane fuel cells consume about 1 ton annually, but promise rapid growth as hydrogen mobility scales. Jewelry and decorative, 10-15%. Platinum's rarity, hypoallergenic properties, and white metal luster make it a luxury choice, especially in Japan and China, where it commands premium pricing. Investment demand, 15-20%. Physical bars, coins, and ETFs, e.g. PPLT, PLTM, offer portfolio diversification. Annual investment demand hovers near 40 tons, buoyed by wealth preservation and central bank diversification in smaller markets such as Thailand. Medical and electronics, 10%. Vital in medical-grade devices, pacemakers, implants, and in hard disk drives for data storage, though this segment is stable rather than growth-driven. Platinum traded around 850 Oz in 2023 to 24 before surging to 1,200 Oz in 2025, up 40% year-to-date. Key drivers include supply disruptions, extended labor strikes in South Africa cut output by 15 tons in 2024. Emission regulation tailwinds, post-pandemic auto production recovery, combined with tightening emission standards in Europe and China, lifted catalyst demand. Hydrogen fuel cell hype. Growing investments in hydrogen infrastructure spurred speculative buying for future fuel cell material needs. ETF inflows. Platinum ETFs recorded net inflows of 10 tons in H1 2025, an all-time high, reflecting renewed investor interest in precious metal diversification. Institutional investors allocate through specialized commodity funds and ETFs with strict position limits due to low market liquidity. Combine physical holdings with OTC forwards to manage delivery risk. Use platinum as a yield enhancer in precious metal baskets alongside gold and palladium. Retail investors access physical platinum bars and coins primarily through dealers and local markets. Face higher premiums, 5-8%, over spot price compared to gold's 2-3%. Leverage platinum ETF products for convenience, but endure wider bid-ask spreads. For retail investors, a modest 1-3% allocation to platinum can complement gold exposure and harness industrial demand growth. Prepare for elevated volatility. Annual price swings of plus 25-35% are common. Consider smaller lot sizes to mitigate high premiums and storage costs. For professional managers, platinum's market size, $7 billion, demands careful position sizing to avoid market impact. Use platinum to express bullish views on emission control legislation and hydrogen adoption. Hedge with platinum futures on NYMEX and LME, balancing delivery location and contract specifications. Extreme supply concentration. With 70% of supply tied to South Africa, geopolitical or operational disruptions can trigger outsized price moves. Emission regulation cyclicality. Automotive demand can swing based on new vehicle sales and regional regulatory changes. Industrial permanence versus speculation. While fuel cell demand could transform demand fundamentals, much current buying remains speculative. High entry costs, premiums and storage costs on physical platinum are significantly higher than for gold or silver. Portfolio role, use platinum as a niche diversification tool, not a core inflation hedge. Long-term outlook, structural supply constraints and evolving emission control and hydrogen trends support higher platinum valuations, though demand remains subject to cyclical auto production. Investment thesis. Platinum's rarity and dual industrial investment profile offer upside from both regulatory tailwinds and portfolio diversification in precious metal allocations. Risk considerations, high volatility, premium costs, and supply chain concentration demand cautious position sizing and rigorous risk management. Tactical opportunities capitalize on auto-regulation announcement cycles, hydrogen project milestones, and ETF rebalancing flows for short-term trading. Platinum stands at the crossroads of environmental regulation, clean energy innovation, and boutique precious metal investment. Understanding its unique supply-demand dynamics is essential for anyone seeking exposure to this rare and powerful metal. Thanks for watching. Share your thoughts below, like, subscribe, and hit the bell icon for more metals market insights. See you next time.